All right, guys, let's quickly take a look at the upcoming ISM manufacturing PMI coming up at 3 p.m. UK time and 10 a.m. Eastern time. Now, this print, as usual, can create some pretty punchy volatility, especially if we get some meaningful deviations in the data. In terms of how we will be trading this today, even though I think this week the markets have started the week slightly less concerned on the political side. Looking at the OAT Bund spread, we've seen quite a big fall, obviously, from last week, where the election outcome that we had yesterday wasn't really enough to bring additional fear into the market. So that has seen those spreads calm down, and as a result, I do think there will be slightly less focus on that in a week like this compared to the last 2 weeks, for example. So we might see the dollar trading slightly more reactive to the incoming data, which is good, but there is obviously that risk that maybe we don't see that playing out. We have seen the dollar being able to discount incoming data very, very quickly over the course of the last 2 weeks. And even though I think a week like that or a week like this will pose less of a concern on that front, it is still something worth just thinking about from a risk management point of view. So keep that in mind as we head into that ISM. Now, in terms of this data, we've had this very strange dislocation over the course of the last, let's just call it 18 months, between the soft data on the one side and the hard data on the other. Normally the markets consider the soft data things like your ISMs and your flash PMIs and your sentiment gauges, etc. Normally the markets sees these as leading indicators, and normally they have a pretty good track record for telling us where the broader economy will be headed. But over the course of the last 12, 18 months or so, there's been that weird dislocation where the soft data last year, for example, showed a massive amount of slowdown, which just didn't transpire into the hard data slowing down. It took a very long time. Eventually, we're actually starting to see the soft data recover, and now only the hard data is starting to show us the opposite, where the hard data clearly, looking at this left-hand side, the hard data clearly showing us there is a slowdown underway. Slowdown doesn't mean a collapse in growth or a collapse in labor or a collapse in the consumer. It just means that it's moderating and slowing down from its prior elevated levels, right? Now, in terms of the soft data, that means that even though, normally we would have seen ISM data pack a big punch, it can still be tradable, but the markets don't trust it as much as a leading indicator as they used to, purely because of that dislocation that we've had between the soft data and the hard data. So these are it's things worth keeping in mind when we approach these data points, because yes, they can be tradable, and yes, if we get a big enough deviation, it can create some sizable directional volatility we can look to take advantage of, but we still need to be careful because there is these underlying dynamics in the way right now that we just need to be aware of. Now, in terms of how we usually trade these events, the first thing that's important to understand is that we never just trade the headline number, which is your ISM manufacturing PMI. We always need to include the sub-indexes, meaning that we can't just look at the headline manufacturing PMI. We need to look at prices paid. We need to look at employment. We need to look at new orders. All of these things together tells us what the market tells us, what the data point tells us about the manufacturing sector, right? So we don't just look at the headline. We need to incorporate all of them into our analysis for the best possible opportunity to trade it. Now, for the most part, what we want to see is we want to see a print that gives us the least amount of uncertainty possible. That means we are looking for the majority of these prints to print either very, very hot or very, very cold, right? We're looking for a big beat across the board or a big miss across the board. That normally gives us the best bang for our buck. Now, there are some occasions where we could see things like a Goldilocks print, for example, where your growth measures might be pushing up, like your headline index, your employment, your new orders. At the same time, you're seeing prices paid fall. That type of Goldilocks print can sometimes be tradable. You also get a more stagflation based print where you see your growth measures pushing lower, but your prices paid pushing higher. Those prints can be tradable, but in a session like today, after the last 2 weeks that we've had and the dollar's reluctance to trade data for what it is, I would opt for something a little bit clearer, right? We don't want to be getting clever looking for that Goldilocks print or that stagflation print. Let's just look for a big miss across the board, a big beat across the board, something that's clear, that's simple. You don't need to have a PhD degree to analyze it. If the numbers are all red and it's ugly, or all green and it's good, That's the type of print that we'll be looking for to try and take advantage of in a session like today. Now, in terms of the numbers, what makes the ISM, PMI, and the services slightly tricky to trade is that we don't normally get a consensus view for most of the data points, right? If you take a look at your manufacturing PMI, there we get a consensus view of 49.1, showing a slight improvement from the prior, with a minimum expectation of 48 and a maximum expectation of 50. We don't really get a solid consensus number for the prices paid, employment, and new orders indexes, which means that for a miss, we'll essentially be looking for the prior number, or a beat, the prior number as our benchmark, as our estimate, if you will. So for a miss, we want to see the actual number below the prior, and for a beat, we want to see the actual number above the prior, right? So the prior will act as our consensus when it comes to the manufacturing print, and in some cases the ISM as well, because there we only get the ISM. Sometimes we do get the prices paid for services, but it normally drips into from the analyst community. It comes in a little bit later sometimes, so we'll just need to keep an eye out for that going into Wednesday. But the bottom line is we only have the headline number, which means the previous will have to suffice. A number below that will be seen as a miss. A number above that will be seen as a beat. Now, there is something we can do even further to try and give us those numbers that will be, that'll give us the best bang for our buck. The first thing we can do, apart from, like I said, looking for a number below the prior, above the prior, is we'll be looking at that magic 50 number, right? We know anything below 50 when it comes to an ISM print suggests industry contraction, and anything above 50 suggests industry expansion. So if you take a look at something like the manufacturing headline, the prior was already below 50 and the expectation is already below 50. So the bigger surprise here, for example, for the manufacturing headline won't be a number that stays below 50, because we had that previously. The biggest surprise here will be for this thing to print above 50, which is not just the market's maximum, but it means that that the manufacturing sector as a whole moved back into expansionary territory, right? So that 50 level, that's the next layer of analysis we can add to that, saying that, yeah, a number of 49.5, for example, will technically be a beat for this. But if we can get above 50, that's just so much better as a beat, right? It pushes back above that psychological level, that 50 level that the markets will be looking at. Same story with something like the employment measure, right? If we get 51, or let's say 50.5, that will technically be a miss. But if we can get something below 50, that's just so much better as a miss. You break that psychological 50 level and the markets pays more attention to it. For something like new orders, we're a little bit far away from 50, but even more so, if we were to get a beat that pushes back above 50, that'll be seen as a massive, massive beat. Similar with prices paid. I mean, at 57, we are miles away from that 50 mark, but the closest we can get to 50 from a miss point of view, the bigger that surprise will be. Now, there's a couple of other things we can look at as well that I just wanted to show you guys here, that could, using this as a way to look for some bigger numbers to aim for to the downside and to the upside. The first one I want to look at here is new orders. To the upside, we said at 45.4, we are miles away from 50, but should we be able to pierce above 50, that'll be seen as a big, big beat for this print. In terms of a miss, you'll notice that the lowest prints we had going back to January and May 2023 was 42.5. So a miss just below the prior of 45.4 will already be seen as a miss, but anything below 42.5 will just hit so much harder for this market. And it's at this rate of change, it's much easier for us to get below 42.50 than it is for us to get back above 50. But either way, above 50 or below 42.5 for the new orders, that will be a number definitely worth looking at. Now, let's quickly take a look then at the employment side of things. We spoke about the employment already. Like we said, if we were to break back below 50, that will probably be enough for the markets to be seen as a miss. In terms of a beat, though, take a look at this. The highest number that we had going back to May 2023 was 51.4. That's not too far away from where we are previously, right, at 51.1, which means that if we were to pierce above 51.4, let's say we print 51.5 or higher, for example, what will that give the markets? That'll bring the quote unquote highest since crowd out, right? So if we can get anything above 51.4, let's say we print at 52, for example, how will the markets pin this? Highest ISM employment print since August 2022, highest since, whatever the date is. So that is important again from a psychological point of view, meaning that anything above this will already be a beat. But should we be able to print above 51.4, which again is not a big stretch here, that'll be seen as a pretty hot number. Like we said, below 50 should do the trick for a miss. Now, in terms of prices paid, this one is slightly more tricky because, like we said, we are miles away from 50. So technically speaking, anything below 57 should do. And the closest we can get to 50, the better. But I'm not expecting us to drift all the way down to 50. Should we get below 50, that will obviously be seen as a huge miss for this market, but we probably don't need to get that low to get a reaction. On the beat though, the number here is obvious that we'll be aiming for anything above 60.9. That'll be the highest since June 2022. So anything above that will be seen as a big beat by the markets on the prices paid side. Now, in terms of the headline index, similar story there. If we can push above 50, fantastic, shows us that we are back in expansionary territory, but even more so, if we can just do slightly better, pushing above 50.3, that'll give us the highest manufacturing, ISM manufacturing headline print since September 2022. So a number above 50.3 will really be, the quote unquote best case scenario beat that we can look for on the headline. And, again, for the headline, at least we've got a minimum expectation there of 48. So anything below, I would say anything below 48 will do. But this recent low going back to February was 47.8. So even though the market's minimum expectation on this is 48, I think the ideal miss for this would be below that 47.8 print. So again, lowest since December 2023 type of thing. So below 47.8 is probably what I will be looking for. Now, we've looked at a couple of different numbers that will give us a big surprise, right? Either to the up or to the downside. But it's important to understand we don't need to have all of these numbers showing that perfect miss or that perfect beat to give us an opportunity. Sometimes if just one of them comes in really, really bad and the others just miss, or one of them comes in really, really good and the others just gives a slight beat, sometimes that's enough, right? So I'm giving you the quote unquote, perfect case scenario for a miss and the perfect case scenario for a beat, but we don't have to have all of them coming in with that perfect miss or that perfect beat. If we have one or two of them that shows a massive miss and the others are just slight misses, or if two of them shows a massive beat and the other two are just slight beats, normally that's enough. So obviously use your discretion when it comes to that. And we know what numbers we'll be looking for, but it doesn't have to be a perfect print normally to get the volatility we're looking for. But obviously the most of them we can get in that parameter, the best that'll be for directional volatility. Now, how can we look to potentially trade a big miss and a big beat? In terms of, let's start with what we would expect across the major asset classes. If we were to get a massive miss across the board today, the baseline reaction that we've seen playing out over the course of the last few months on a miss has been dollar downside, yield downside, along with equity and precious metal upside. Now, in a session like today, I would be a little bit more cautious on trading equities higher as well as precious metals higher on a miss in the data, because at some stage we're going to get to a point where the worse the data gets, it's just not going to be as positive as it used to be for equities, because at some stage the markets will view bad data as being bad. I don't think we are there yet, which means that the baseline expectation is still for equities to go up, precious metals to go up if the data is a miss. But there's a difference between expecting it to happen that way and having the conviction to trade it that way. I don't have the conviction to trade it that way, which means I'm rather going to stay patient. When it comes to the bond market, even though we would expect things like bonds to push up on a miss, i.e. yields to push down on a miss, I'm going to stay patient on it because I was actually kicked out of my bond long from a couple of sessions ago that I got into the T-bond longs. We had a huge deceleration to the downside in T-bonds, breaking back below that 200-day moving average as well. I'm not quite sure why the bond market reacted that way. The only thing that I can pinpoint to now is the fact that oil has remained well supported. And on the back of that, we've seen things like inflation expectations continue to grind higher. That should put some upside pressure on yields. There's a lot of players that I follow that trades fixed income only. And for a lot of them, they just point to month-end and quarter-end flows as the reason. Now, if that was the only reason why bonds traded the way that it did on Friday, then you would have at least expected a little bit of a pullback. And we're not seeing that right now. So bonds is giving me a bit of the heebie-jeebies here, which means that even though we would expect bonds up, yields down on a miss, I'm not going to look to express that via the bond market because I'm just not seeing it react the way that I would expect it to. So that really only leaves me with the dollar. So if we do get a massive miss in the data, we could potentially look for some short-term downside to play against the US dollar. Now, if we take a look at the currency chart for today, the pound is just so strong, and I just don't understand why. I think the fundamental reasons for why the markets have liked sterling, I think a lot of those reasons are reflected in the price. I think a lot of those reasons are actually starting to deteriorate and push in the other direction, but sterling continues to push up. I'm not interested to short the dollar against the pound, i.e. looking for pound dollar upside, even though it's the strongest currency in the session. I would rather opt for something a little bit simpler in a session like today, which is obviously looking at the euro. The euro has seen upside with a gap to the upside over the weekend. As the spreads have calmed down and the markets have just eased a little bit of that risk premium. So looking for a little bit of euro dollar upside on a massive miss, I think that makes the most sense in a session like today. We are currently trading around that implied volatility high, which coincides with these prior levels of resistance as well, which should now act as support. And we can see just a cluster of resistance sitting between that 107.70 and that 107, let's just call it 107.850. We've got the implied volatility second standard deviation high. We've got a key level of support and resistance around the 177, and we've got the 200-day moving average, as well as the low going back to the 30th. So this is just a whole cluster area of resistance. So if we do get a massive miss, that could be a possible area to aim for to the upside as a very simple liquidity trade in a session like today. Then in terms of a massive beat, again, we would expect the opposite on a beat, right? For a beat, we would expect dollar upside, yield upside, and equity and precious metal downside. Now, again, I'm going to stay patient when it comes to the bond market for the reasons that I just explained. I'm going to stay patient when it comes to equities for the reasons that I just explained. Precious metals might be more interesting. I mean, this move in gold has been quite aggressive. And if you consider the amount of stretched positioning that we have right now in gold, I think gold could be a little bit more vulnerable to downside if we get a really strong number. Again, it's a lesser conviction trade that I'll be looking for here, but that is something that we could consider as a possible short opportunity. I would, again, prefer to trade the dollar. I think that's going to be simpler. But if you are in the markets for trading precious metals, then downside would probably be my preferred direction on a beat, as opposed to trying to chase it higher on a miss. So looking for a move back down towards 23.18 could be on the cards, and then potentially a move back down towards 2300. I don't think we get quite there on a miss, on a beat, but let's see. If it's a strong enough number, maybe it's going to be enough to see us revisit those lows. Again, my preference would be for the dollar. If it's a massive beat, we can look for some short-term upside in the dollar. The risk here is that we are trading at some pretty elevated levels, so 106 will be a very key level of resistance for us to watch. We know that the dollar is also, from a positioning point of view, is trading or is a little bit stretched on the upside as well. So we don't want to push our luck with looking for longs, especially with that big reduction we've seen in the spread, which should push the dollar lower. But again, if the data is strong enough, at least it could give us a little bit of a run to the upside. Currency pairs that we can look to opt to trade against or currencies that we can look to trade against the dollar if we do get a big miss. From a pure tactical point of view, I would say Kiwi and the Aussie. Because if it is a really strong number, we would expect a little bit of risk of sentiment playing into the markets. And if you consider, once again, just positioning these currencies, even though fundamentally it makes sense for why the markets like them on the long side, they are pretty stretched at these levels. We looked at these charts earlier for the Aussie dollar. pretty stretched here to the upside. Very similar story for the Kiwi as well. So as a pure tactical play, we could potentially consider some Aussie dollar, US dollar, and Kiwi dollar, US dollar shorts if it's a really strong number. In terms of levels to aim for there, for the Aussie, I mean, we've been stuck in this range between, let's just call it the 66 to the downside and 67 to the upside. So looking for a possible revisit of that 66.30, maybe even lower, could be on the cards. We also have the implied volatility low coming in quick to that level or close to that level. And in terms of the Kiwi, next key level to aim for would be very close to where we are now, to be honest. That 60.80 has been a pretty key level for this market for a while now. Below that, we've got the implied vol coming in at 60.60 as well as the low from Friday. So maybe that could be an area of support to aim for around that 60.50 psychological level. But those two would probably be my preference to trade in a session like today. There's nothing wrong opting for something like the CAD, but it's pretty stretched. There's nothing wrong opting for something like the Swiss franc as well. You know, maybe some dollar Swiss upside could be on the cards. We are testing, though, a major level of resistance here, which is the only thing that's getting me a little bit cautious on trying to trade this. But should we break above this? I mean, we could have some room to run here. Let's see where the implied vol second standard deviation is here today. It's coming in around that 90.50 psychological level. So I suppose there could be something there to aim for. But just note that you are trading in key resistance here. So it does make it a little bit more risky. And maybe we see the markets, maybe we see this as as acting as a bit of a too strong resistance for this pair. But let's see. I mean, that could also be on the cards. It is the weakest currency on the session. So if the data in the US is really strong, it would make sense to pair that against something like the Swiss franc from an intraday point of view. So that's just a quick look at the ISM manufacturing. As always, any questions, don't hesitate to let me know.